In 2001, Enron was named America's most innovative company for the 6th year in a row. 6 weeks later, it filed for the largest corporate bankruptcy in American history. $60 billion. Gone. 20,000 employees lost their jobs. Their pension funds were wiped. The people who ran the company walked away with hundreds of millions of dollars. Here is what every documentary, every book, every film about Enron tells you. It was fraud. It was greed. It was a few bad men who broke the rules and got away with it. That story is not wrong, but it is incomplete because the part nobody tells you is this. Enron was doing exactly what the United States government had designed the energy market to allow. The rules did not just fail to stop them. The rules invited them in. By the end of this video, you will understand not just why Enron collapsed, but why the system that built Enron is still running today, with different names on the door. To understand Enron, you have to understand what happened to the American energy market in the 1980s and the 1990s. For most of the 20th century, energy was boring on purpose. Electricity and gas were regulated utilities. Companies could not charge whatever they wanted. Profits were capped. The government essentially said, you can exist, you can make money, but not too much money, because people need heat and light to survive. Then came deregulation. Starting in the late 1980s, the federal government began dismantling the rules that kept energy boring. The logic was straightforward and, on paper, reasonable. Competition drives efficiency. Let the market set prices. Let companies innovate. Let consumers benefit. Energy deregulation created something that had never existed before, a market where you could trade electricity and natural gas the same way you trade stocks. Buy it here, sell it there. Profit on the spread. Enron saw this coming before almost anyone else. They didn't just prepare for it. They lobbied for it. They helped write the rules. They funded the politicians who passed the legislation. And then, when the game was ready, they played it better than anyone thought possible. Enron started as a boring natural gas pipeline company in Houston, Texas, the kind of company that made money by owning pipes and charging to move gas through them. It was a pipeline business. But in the late 1980s, a man named Jeff Skilling joined the company with a different idea entirely. Skilling wasn't an energy man. He was a consultant from McKinsey. He saw Enron not as a pipeline company, but as a bank, a financial institution that happened to trade energy rather than money. His pitch was this: Enron should become a market maker, not just a company that moved gas, a company that created the market for gas. That set the prices. That stood between every buyer and every seller and took a cut of every transaction. The model worked. By the mid-1990s, Enron had expanded from gas to electricity to water to broadband. They weren't just trading commodities anymore. They were trading anything with a price. The Wall Street Journal called them a revolutionary company. Harvard Business School wrote case studies about them. Their stock price went from $10 in 1990 to $90 in 2000. And then came California. This is where the story gets genuinely strange. And this is where the Mavenish version of this story diverges from every other version you've seen. In 1996, California deregulated its electricity market. The theory was the same as the federal version: competition, efficiency, lower prices for consumers. What happened instead was a crisis. In the years 2000 and 2001, California experienced rolling blackouts. Electricity prices spiked by up to 800%. The state was paying more for power than at any point in its history. Businesses closed. Hospitals ran on generators. The governor declared a state of emergency. The official story at the time was shortage, not enough power, a supply problem. The real story, which only emerged years later through internal Enron recordings, was different. Enron traders were deliberately creating artificial shortages. There are recordings of Enron traders laughing about creating congestion on California's power grid. They instructed power plants to take capacity offline, not because the plants needed maintenance, but because less supply meant higher prices. They had names for the strategies: Death Star, Fat Boy, Get Shorty. One recording has a trader telling a plant manager to just get it out of California, referring to electricity that California desperately needed. Here's the part that almost nobody talks about. California's deregulated market allowed this. Not just that it was technically allowed, it actively created the conditions for it. The rules that California wrote, with input from federal regulators, created a system where these strategies were, in many cases, legal. The Federal Energy Regulatory Commission received complaints from California as early as 2000. They reviewed them. They concluded the market was functioning as designed. Enron was playing the game. California had built the game. And when California ran out of money to keep playing, the state signed emergency contracts worth billions to keep the lights on. And Enron collected. The question isn't why Enron did it. The question is why everyone who designed the system was surprised when someone did. In March 2001, Enron stock was trading at $63. The company had just been named most innovative for the 6th consecutive year. Analysts were near universally bullish. The consensus on Wall Street was that Enron was untouchable. A reporter named Bethany McLean was working on a story for Fortune magazine. She had one question: how exactly does Enron make its money? She called investor relations. She asked Jeff Skilling directly. She read the annual reports and the filings with the Securities and Exchange Commission. Nobody could give her a clear answer. In March 2001, Fortune published her article, "Is Enron Overpriced?" It was 6 pages long. It did not accuse Enron of fraud. It simply noted that for a company with a $90 billion market capitalization, it was remarkably difficult to understand where the money actually came from. Enron's response was to call her naive. The company sent executives to Fortune's offices to challenge the story. Jeff Skilling called her on the phone and, in a moment that became famous, called her unethical. She was the only person in mainstream finance who had asked the question. The stock peaked in August 2000. By October 2001, internal whistleblower Sharon Watkins had written a memo to the chief executive, warning that the company might implode in a wave of accounting scandals. By December 2001, Enron had filed for bankruptcy. The fraud, the actual fraud, the hidden debt, the off-books partnerships, and the manipulated earnings had been running for years. Hundreds of analysts, auditors from Arthur Andersen, board members and regulators had reviewed Enron's books without seeing it, or without wanting to see it. Here's what the Enron story is almost never used to illustrate. After the collapse, Congress held hearings. Executives went to prison. Arthur Andersen was destroyed. The Sarbanes-Oxley Act was passed, introducing sweeping new rules about corporate accounting and governance, and a renewed focus on accountability. Enron was treated as an aberration, a case of individual criminal behavior. Bad people doing bad things. The California energy market was re-regulated. Enron's strategies were classified as market manipulation and banned. What was not re-examined was the underlying logic that had built the whole system. The idea that complex financial instruments should be allowed to trade energy. The idea that deregulated markets self-correct. The idea that private companies can be trusted to manage public utilities when profit and public interest point in opposite directions. 7 years after Enron, the same logic, complex instruments, deregulated markets, and private companies managing systemic risk produced the global financial crisis. Different names, different instruments, same architecture. The Enron executives who went to prison deserved to go to prison, but the story that ends with their sentencing is a story that lets the system off the hook. The Maven number for this story is $60 billion. That is the amount Enron's shareholders lost when the company collapsed, not $60 billion stolen by fraudsters operating in the dark. $60 billion lost in a company that was publicly traded, audited annually, covered by hundreds of analysts, rated investment grade by every major ratings agency, and named the most innovative company in America for 6 consecutive years. The number isn't about Enron's greed. It's about the gap between what the system was supposed to catch and what it actually caught. That gap was $60 billion wide. Which brings us to the third entry in the Maven Rule book. The Enron Rule, when the rules are designed to reward a behavior. Calling that behavior fraud is just choosing a scapegoat. Enron broke laws, but Enron existed because of laws. The deregulation that created their market, the accounting standards that allowed mark-to-market revenue recognition, the regulatory framework that reviewed and approved their structures. None of those things were Enron's invention. You'll see this rule everywhere once you're looking for it. Banks in 2008 selling mortgage products that met every regulatory standard while hollowing out the financial system. Pharmaceutical companies pricing drugs at whatever the market bears because pricing is unregulated. Technology platforms monetizing attention in ways that are entirely legal and entirely destructive. The rule that rewards the wrong behavior always finds someone willing to follow it perfectly. Remember that number. Remember that rule. That's Mavenish. Every video, one story, one number, one rule. If this is the first time you have heard the Enron story told this way, subscribe. There is a version of almost every business story you think you know that the mainstream did not tell you. I will see you in the next one.